So you want to start investing, but you're confused about how to do that. Well, in this video, I'll give you a walkthrough that will help you understand how can you start in this journey of personal finance. If that excites you, make sure that you watch this video till the very end. I'll be talking about a number of different topics that will help you clear your mind and get you on this journey of finance and investing. I started my journey back in 2020 when I got my first salary, and hence I want to share all the lessons with you. This by no means is a financial advice that you have to follow. It's just my own journey and the lessons I learned from it. You are free to follow it or to not do that. Hit the like button and let's get started. The biggest mistake people make when they start their journey of investing is when they first get the salary, let's just say that you get your salary in the month of March, you immediately start investing it in the stock market. Well, that's not exactly the right way to go ahead. What I did is that I built myself an emergency fund. The first rule of personal finance is to create a fund that you can use in emergency. Now, how much should this emergency fund be? It depends on you. I personally like to keep it about 6 months of my current earning. So let's just say that you are a software engineer working in a top tech company making about 1 lakh per month. If you have about 6 to 7 months of funds in your savings account, then you can move ahead with the rest of the things. Some people also like to put their emergency fund into a liquid fund that they can withdraw from at any given moment, but I like to keep it in my savings account itself. So that is the most important rule to remember. Most people do not do that, and whenever they do need some funds, they have to withdraw from all of their mutual funds and other stocks, and they might end up paying some short-term capital gains tax and other things like that. So let's say you first built out an emergency fund for yourself. The next step is to focus on getting yourself a health insurance. Yes, it's not the time for you to start investing, it's the time for you to take care of your own health and the longevity of your life, and that's where health insurance comes into picture. I have been investing from 2020, but only recently, last month in 2023, I purchased a health insurance for my own self. But I am so glad that I did it at 21 rather than doing it at 30, 35, 40. And let me tell you the reason for that. So getting a health insurance when you're younger will help you get lower premiums as well as no wait list, right? So sometimes when you are older, let's just say 30, 35, 40, or if you have an illness, then you will have to have a waiting period of 3 to 4 years before you can get this insurance. Versus in the case of your youth, you do not have any illnesses, and so the insurance company can bet on you staying healthy for longer. So if there are any accidents, any injuries, any operations that you go through, this health insurance will be covering all of that. Make sure that you read all the terms and conditions of the insurance before purchasing it and get it from a reputed company. So that is the first step. Also get a larger cover. Like I have a cover of 1 crore for my insurance, and I think that's a good number for everyone out there as well. This is not sponsored, but if you want to learn more about insurances, you can check out Ditto and get on a free call with them, and they will explain you all the differences, and they will tell you which is the right insurance for you to go ahead with, which is the right coverage that you should go for, and that is going to be a great way for you to pick the right insurance for yourself. If you're curious, I'll also put some links in the description for you to learn more about insurances. The next step is to understand your risk appetite. Now, this is a very important concept in finance in general. This is very important because once you understand what phase of life you are in, you can understand how risky can you be in the market. And once you have this framework in mind, it's going to help you a lot when picking the right stock for you according to your risk behavior. So let's just say that you are a 21-year-old, you just got a job, you have a lot of years ahead of you, you can take a lot more risk, you have no dependencies, and you are a lot more excited and enthusiastic when it comes to the stock market. Versus, let's just say that you are 40, you have 2 kids, you have a wife, you have your parents that you need to take care of. In that case, you need to conserve your cash. You are going to be much more careful for how you deploy your money and in which stocks or mutual funds do you invest in. So make sure that you understand that one thing, and once you have that clear in mind, we can move on to the next step. The next step is to figure out how much should you invest into equity, debt, and gold and other instruments. In my case, I am a 21-year-old. I have a lot of growth ahead in my career. Hence, I am willing to take a lot more risk. And because of that, about 70% of my complete portfolio is invested in equity and equity linked mutual funds. Another 10% is into bonds and debt based instruments. And then I have about 10 more percent into gold. I've bought some gold ETF, and the last 10 goes into real estate. So that is how I have created my diversification. I want to take more risk, and I am looking out for that crazy returns as well. But you do not need to do that. You can be conservative. It just depends on how you want to structure your risk appetite. Now, as I've just talked, you have equity, you have debt, you also have gold, but on the other hand, you also have something called as options trading, and that is what you can also explore with ICICIdirect. Now, when we enter the stock market, our minds race with the thrill of the chase, the thrill of finding that one stock that will make us rich, the thrill of outsmarting the market and coming out at the top. But making money in the stock market isn't just about luck, it's about strategy. And when it comes to strategy, trading is the way to go. But trading can be tricky, especially when the market is volatile. That's why you need ICICIdirect, the trading partner that will make it all easier for you. With ICICIdirect services like order slicing and flash trade, you can split your order into smaller sizes and execute them in seconds with just one click. For a limited time, ICICIdirect is offering all of its services at just 7 rupees per order, which is a 65% discount over the current rate of 20 rupees per order. All you have to do is register with ICICIdirect, and the best part, it's absolutely free. This offer is open to resident individuals and HUFs, so don't wait any longer. Experience the most seamless options trading at a fraction of the cost. So click the link in the description and register on ICICIdirect. Don't miss out on this opportunity to outsmart the market and make your fortune. And now let's get back to the video. Alright, now step 3 is to figure out your budgeting, right? It's very important that you budget and create separate bank accounts, right? So let's just say you get your salary in one account, you can divert all of your funds into 3 different accounts, right? So first of all, it's going to be your savings, then will be your needs, then will be your wants. I know that the rent of this house is a need. I cannot live without a house. The electricity bill, the taxes I have to pay for other things is a need for me. The freelancers who work with me, I have to pay their salaries, so that is a need for me. Me going out and having a coffee at Starbucks, that is a want. That is a luxury that I can choose not to have. Me buying more clothes for myself is a want. So make sure that you differentiate all of your expenses between the essentials, the needs and the wants, and the savings. If you ask me, about 25% of everything I make goes into my needs, my requirements. About 10% more goes into my wants, and then the rest is saved. And I like to create multiple accounts so that I do not see much money in my account, right? I think this is one of the biases that we have in our head, that when we see a lot of money in our account, we are tempted to shop more, to spend more, right? But when you will keep that savings portion away in a separate account and you will only be using the spending account to get all the transactions, you will see that you only have 10,000 rupees. So you'll be a lot more mindful versus if you just had one account and you had 50,000 in that one account. So make sure that you understand this very important concept. Create multiple accounts for yourself. If you like to go on trips, then you can have a different account that is just going to help you for the trips, for the vacations. If you are maybe older and you want to plan for the education of your kids, then maybe have a separate account that is all about that. This will help you stay structured and get things done faster without any complications. The biggest problem I see with people around my age is that they are mindlessly spending money without having a budget in their mind. Make sure that you understand this very important concept of budgeting. This will help you on for the rest of your life, so keep this in check. The next step, you might be thinking, should you get a credit card or no? If you've just started earning, credit cards might be tempting. So here is what my take on this is. I have one credit card right now. I'll just show that to you right here. So this is my credit card that you can see, and this is the Amazon ICICI bank credit card. The way this works is that whenever I use it, I get about 5% cash back when I transact with it on Amazon. So I'll be saving 5% of everything that I spend. Now the problem with credit cards, in my opinion, is that it makes it a lot easier for you to spend, right? Like you will naturally be more inclined to spend money as much as possible because of all the rewards that you would get. But if you're someone who likes to travel a lot, if you're someone who goes to a lot of places, stays at a lot of hotels, it makes a lot of sense for you to invest and get yourself a Vistara Access credit card, or you can also find the HDFC Infinia card. You can find a ton of different cards that come with a lot of different perks. Let's just say you travel a lot, so you can get the Vistara membership, and through that you can get free upgrades to premium economy as well as business class tickets, as well as you can get free tickets at the same time. I think I need to get one of those because I travel a lot. I've taken over 60 flights in the last year itself, so I will be doing that in some time. But I think when you're just getting started, credit card is not really required, and it just makes you more willing to spend money. And it's just very simple to just tap the card on the machine and spend that money, versus if you actually carry notes, you will be much more mindful of where you eat food, of where you go to watch a movie, of how you live your life. So just make sure that you understand this one very important mindset shift that happens when you get yourself a credit card. Also, one very important tip is whenever you go into the settings of your app, for the banking app, go and change from minimum amount due to total amount due. Essentially, the billing cycle, whenever it ends, it has this capability of transacting only 5% of the due amount of your credit card from your savings account. Now you should disable that and make sure that you turn on total amount due, because the way this works is that it will only take 5% from your savings account and the rest you will be charged interest on. Right? So make sure that you understand it and make sure that you are more mindful of it. This is the first setting I changed when I got myself that ICICI Amazon credit card. The next step in your journey of personal finance is to invest in PPFs. Yes, you are still not going to invest into stock market, and that is because with the help of PPFs, you can invest up to 1.5 lakh rupees every single year, and you end up getting 10.14% returns before taxes and over 7.1% returns after taxes, risk free. Imagine you are giving money to the government and the government is paying you 7% interest without any taxes, completely risk free. This is one of the best things you can do. So make sure that every single year between 1st to 5th April, you accumulate 1.5 lakh rupees and you just invest it into a public provident fund account. You can go to your bank and ask them to create a separate PPF account for you, and you can start taking your money from your savings account and putting it in that PPF account. There will be a lock-in period of 15 years and you can also extend that by blocks of 5 years. But I think that this is a great way to create that habit of saving, and at the end of 15-20 years you'll have a good lump sum amount. Let's say you invest 1.5 lakh rupees every single year. At the end of 20 years you would have invested over 30 lakh rupees. Now that 30 lakh rupees with 7% risk-free returns after taxes would have gotten you 66 lakh rupees. You would be making an additional 36 lakh rupees tax free. So that is how that works. I hope this makes sense. If it does, make sure that you hit the like button. The next step is to understand the different ways through which you could invest in the stock market. Number one is passive investing, and then you have active investing. In passive investing, you know that you will not be putting time into analyzing all of the stocks of the companies. You are basically picking a few stocks, or you're picking some ETFs, or you're picking some mutual funds, and you are consistently investing into them using something called as a systematic investment plan. Instead of you investing just at one point in the whole year, you have spread out your investments into every single month on a specific date called as an SIP. Now SIP is something that I think everyone should start. You can start with as low as 500 rupees or 1000 rupees on platforms that are available to you. You can access Zerodha, you can also use Grow, you can use Upstocks, you can use ICICIdirect, you can use whatever you want to. But the idea here is to start an SIP so that you don't have to come back and invest again and again. The biggest pro of passive investing is that you're saving your time and your energy. Whenever you will look at the market every single day, right, you will yourself feel that anxiety कि यार मेरा स्टॉक मार्केट का पोर्टफोलियो डूब गया तो मैं क्या करूंगा, अगर उसने अच्छा परफॉर्म नहीं किया तो मैं क्या करूंगा, should I sell something, should I buy something? No. You are just investing on a particular date and a particular time, and you are doing that consistently because you actually trust that asset. That could be an ETF, it could be an index fund, it could be another mutual fund, whatever it is that you want to invest into. You're just doing that consistently and creating that discipline in life. Personally, I like to invest into an index fund, and I just do that consistently every single month, and through that I am able to create some great returns. I do not need to worry about which stock to invest into, which is the best opportunity, aaj kya niche gaya, aaj kya upar gaya. I do not care about all of that. I will put all of that mental energy and bandwidth into building something of my own, building my agency, making a YouTube video, and spreading more financial knowledge and education. So that is how I like to think about it. You can be the complete opposite. If you want to be an active investor, you can absolutely do that. In that case, you will have to look at something called as technical analysis. In the case of long-term investing, you are actually looking at fundamental analysis. In this case, you are looking at the health of the company, the numbers that the company has. That could be the revenue, that could be the profit, that could be the debt the company has, and how are these numbers changing over the years. There are certain ratios and numbers that you have to look out to, like EBITDA, like price to earnings ratio, like a lot of different numbers that you need to keep in mind before you decide to invest into a particular stock or into a particular mutual fund. So that is very important to remember. The next step, if you want to become an active investor, you'll be looking at something called as technical analysis, in which case you'll be looking at the momentum of that stock, not the financials, not the fundamentals of the stock, but the momentum of the stock. You would have to learn to analyze candlestick patterns, and through that you will understand if this is the right opportunity for you to invest, or for you to sell, or for you to short, or do any of these other things. But this is a very important concept for you to always remember. By the way, if you're confused about the stock market, it can be thought of a marketplace wherein you have various different companies, and each company has, let's say, 100 shares. If you take one of those shares and you pay them money in advance, you get to have an ownership. You own a piece of that big company, and hence, as a result of that, you are now a stakeholder. If they have to take any decisions, they will roll out a voting form to you, and depending on what you decide and how much equity you have, you can have a say in the company, right? Obviously, if you have just one share and if they gave it to you, you have a different choice, but the majority of people want to go ahead with XYZ, then they will go ahead with it, but you are an owner of that business that you intend to invest into. So that is what fundamental analysis, long-term analysis is all about, thinking of yourself as an owner of this business and not just a profit money making machine or things of that sort. So that is the first most important concept. Every single year, these companies release something called as an annual report, in which they lay down all of their statistics, all of their numbers. You have a balance sheet, you have a profit loss statement, you have tons of other information about the company, and all you have to do is to read through all of that and understand if this is the right company for you to invest into, or if this is the right space, is this a right industry for you to invest into right now. So make sure that you analyze all of this and then take a call to invest into a company for the long term. If you're into day trading, then you need to focus on the technicals. You need to be great at understanding patterns of these different stocks and how will they be performing in the future. You need to be good at predicting that. So that is the pros and cons. By the way, for active investors, the bad news is that 99% of active investors actually end up losing money. So you need to be very much mindful. In case of passive investors, over 95% of them end up making money, versus in the case of active investors, most of them end up losing money and their time that they've invested as well, and their peace of mind as well. Acha, that being said, there are multiple books that you can use to learn about investing in a much better and deeper manner. I also have a separate video in which I've actually taken you and explained all the different candlestick patterns. I have explained about long-term investing, how do you analyze a stock, how do you look at a balance sheet, how do you understand about all of these numbers and what they really mean to you. You can check out that video with the link in the description, but today we're just talking about the basics of personal finance. So today I want to share with you some of the best lessons I have learned from this book called as The Psychology of Money. I have that book right here at the back, but I will be talking about some very important concepts from that one book. The first concept it talks about is to focus on time in the market and not timing the market, right? Many people, the mistake they do is that they're always thinking of when should I invest a lot of money at the same time to get the most return, versus how can I consistently invest in the stock market and get a larger payout at the end of 5, 10, 20 years. So that is a very important concept to understand, because nobody really knows where the stock market will go in the future. We might have some predictions about it, but we just cannot predict that. We can look at the past, but the past only rhymes. It never repeats itself. So you need to make sure that you understand this importance of time in the market instead of timing the market. Morgan Housel also talks about the emotions that play into your life as an investor, right? आपने वो मीम देखी होगी कि जब मार्केट ऊपर जा रहा था तो मैंने वो स्टॉक खरीद लिया, जब वो मार्केट फिर नीचे आ रहा था तो मैंने फिर बेच दिया, जब वो ऊपर जा रहा था मैंने वापस खरीद लिया, फिर जब नीचे आया तो वापस बेच दिया. So all of this happens because you are constantly emotionally stressed out about your money, and that's why you keep selling, buying, selling, buying, buying, selling. So you need to be mindful of this one very important concept, and that is of fundamentally analyzing the company before investing and then staying with it through the thick and the thins, and not let your emotional mind act and sell the stock. Another great topic to understand is that of compound interest. Like whenever you are investing into a stock, let's say you invest 100 rupees, you get, let's just say 10% in the first year, so that becomes 110 rupees. The next year you again get 10%, but that is on the whole amount. So you now get 121 rupees. The interest you get is 11 rupees and not 10 rupees. So you end up getting interest on the principal plus the interest of the previous year, and then you get interest on all of this amount, and then you get interest on all of this amount. It becomes like a snowball effect. At the end of your investing journey, you would be making a lot of money just with the help of compound interest. If you have a look at the net worth of Warren Buffett throughout his age, this is how that graph looks, and it is an exponential curve because of the importance of compound interest. One more great concept is that of diversification. Now this is really important. Most of the people find out this one stock that is a multi-bagger according to them, and they start investing all of the money into that, and they end up losing a ton of money. And the problem with that is they did not diversify. Depending on their risk appetite, they should be diversifying their investments into different stocks, into different mutual funds, into different assets, and make sure that whenever any of these stocks go down, their entire portfolio does not go down along with it. So that is a very important idea that you need to keep in mind whenever you are thinking of investing. So those were some very interesting lessons from Psychology of Money by Morgan Housel, an amazing book to read if you are interested to learn more about finance and the mindset people have with money and investing. Go take a look at that book if you're interested. Go also take a look at ICICIdirect with the link in the description. Thank you so much for watching this video. If you have any questions about any of these topics, let me know in the comment section. I will be putting up a lot of links in the description that will help you learn about everything. There is an in-depth tutorial on my channel about stock market investing, so go take a look at that if you want to learn more about mutual fund क्या होते हैं, index fund क्या होता है, ETF क्या होता है, सब में difference क्या होता है. You can learn all of that through that one 40-50 minute video. Thanks a lot for watching. You can share this video with your friends, and this was a quick guide of personal finance if you are just getting started in your career. Thank you so much. I will see you all in the next video.